price of gold is moved by a combination of supply, demand, and investor behavior. It seems simple enough, yet the way those factors work together is sometimes counterintuitive. For instance, many investors think of gold as an inflation hedge, and that has some common sense plausibility, as paper money loses value as more is printed while the supply of gold is relatively constant. As it happens, gold mining doesn't add much to the supply from year to year. So what is the true mover of gold prices? First thing to think about is the correlation to inflation. Economists Cloud B. Erb of the National Bureau of Economic Research and Campbell Harvey, a professor at Duke University's School of Business, have studied the price of gold in relation to several factors. It turns out that gold doesn't correlate well to inflation. That is, when inflation rises, it doesn't always mean that gold is necessarily a good bet. The bigger driver is typically fear. During times of economic crisis, investors flock to gold. When the Great Recession hit, for example, gold prices rose. But gold was already rising until the beginning of 2008, nearing $1,000 an ounce, before falling below $800 and then bouncing back and rising as the stock market bottomed out. That said, gold prices rose further even as the economy recovered. The price of gold peaked in 2011 that was the all-time high of $19.06 per ounce, and it's been seeing its up and downs until basically last year. In the first quarter of 2020, gold rose past $2,000 an ounce and broke through its all-time high. In their paper titled The Gold Dilemma, Erb and Harvey noted that gold price has a positive price elasticity. That means that there aren't any underlying fundamentals to the price of gold. If investors start flocking to gold, the price rises no matter what the shape of the economy is or what monetary policy might be. That doesn't mean that gold prices are completely random or the result of herd behavior. Some forces affect the supply of gold in the wider market. Gold is a worldwide commodity market like oil or coffee. Let's talk about supply factors. Unlike oil or coffee, however, gold isn't consumed. Almost all the gold ever mined is still around and more is being mined each day. If so, one would expect the price of gold to plummet over time since there is more and more of it around. So why doesn't it? Aside from the fact that the number of people who might want to buy it is constantly on the rise, jewelry and investment demand offer some clues. Gold is kept away. If you have a gold wedding ring, you keep it until, well, you aren't married anymore. Gold jewelry is kept in some box in someone's home. Golden cars and phones stay in that car and phones until they can't be used anymore. And that's years, decades, it just never comes back. In other words, gold is typically retained by people for years, long periods of time. Number 3, let's talk about central banks. The big market movers of gold prices are often central banks. In times when foreign exchange reserves are large and the economy is humming along, a central bank will want to reduce the amount of gold it holds. That's because gold is what the way they look at it is sort of a dead asset. Unlike bonds or even money in a deposit account, it doesn't generate a return. The problem for central banks is that this is precisely when the other investors out there aren't that interested in gold. Thus, the central bank is always on the wrong side of a trade, even though selling that gold is precisely what the bank is supposed to do. As a result, the price of gold falls. Number 4, let's talk about ETFs. Besides central banks, exchange-traded funds or ETFs are now major gold buyers and sellers. Both ETFs trade on the exchanges like stock and measure their holdings in ounces of gold. Still, these ETFs are designed to reflect the price of gold, not move it. Do know this though, gold retains value. One good thing about gold, it just typically retains and holds its value. That basically means that what gold was worth 50 years ago is the same as it's worth now. Unlike the dollar, with inflation, a dollar 50 years ago is 90% less powerful than it was 50 years ago. To put that in context, a dollar back then could buy you a 10-ounce package of Captain John's flounder fillet or 2 pounds of bacon. Now a dollar can't buy you anything inside the dollar store plus tax. It's lost so much value. Compare that to gold. Back in 1960, an ounce of gold could buy you 362 10-ounce packages of Captain Flounder's fillet or 632 pounds of bacon. Fast forward to now, an ounce of gold can buy you 5,600 ounces of flounder fillet of a comparable brand. The bottom line is that it's important for you to know what role in your portfolio you want gold to play. Unlike gold, it won't yield dividends. Many of its industrial uses are still in development and will take years to develop. It's a long-term safe haven investment, a store of value, and its potential is best realized if you keep it in its portfolio for decades. If you want to start investing in gold now, or silver, or other precious metals, or if you simply have questions or want more information, go check out our website at noblegoldinvestments.com. You can hit the link below and it'll take you there. If you want more information, continue watching this video series. Alternatively, you can go to our website and download the free guide, and that'll give you a lot of great information also.